So guys, like I said, as an investor, you need to have a portfolio of at least 10 companies, at least 10. But you can go up to like 15 or 20 or 25, but minimum 10 companies. Why? So that you have a balanced portfolio. Think of it kind of like a meal. You know, to be healthy, you need a balanced meal. You can't just eat protein all the time, although protein is really good for you, right? You need protein, you need carbohydrates, vegetables, and vitamins. You need a balanced diet. So same thing with your portfolio. It has to be balanced. Let me give you an example. Now, how many of you know that about 2 weeks ago, technology companies started coming down, right? Microsoft and Apple and Tesla started coming down. Have you know that? Right? And as they started coming down, what went up? Cyclical companies went up, right? Banks went up. Industrial companies went up. Okay, we call that sector rotation. So those people who only invest in technology, guess what? Their portfolio would have dropped in value in the last 2 weeks because all their stocks are concentrated in those tech companies. But during that time, my portfolio went up. Why? Because while my tech stocks went down, my bank stocks, my insurance stocks, my cyclical stocks went up. Okay, and it went up more than my tech stocks went down. So in the end, my portfolio grew consistently. So the key to consistently growing your portfolio is to have a balance. So when one goes up, or rather when one goes down, the other one goes up to balance it off. Does it make sense? Very, very important, right? Okay. So what kind of companies should we have in our portfolio? Now, I divide stocks into 6 main categories, as you can see over here: large growth, defensives, cyclicals, speculative growth, turnarounds, and dividends. All right, so let's go through them one by one right now. The first type of company or stock that we can buy, I classify them as large cap growth stocks. So these are huge companies that dominate their industry that are growing at least 20 to 30% a year, right? So large companies, at least 100 billion in market size in secular growth industries, growing at 20 to 25% a year. And these companies have consistent growth in sales, net income, and cash flow from operations, regardless of the economic cycle. Okay? They have wide economic moats, brand monopolies that protect them from competition, and they are in, again, secular growth industries like, e-commerce and fintech, health tech, social media, cloud computing, and so on and so forth. Now, usually, the share price is expensive because these are great companies, right? But we need to be patient and buy them when they're temporarily cheap during bad news, like the trade war, like the recent sell-off, right? Does it make sense? Okay. So you guys tell me, can you name some companies that you think fit the first category? What do you think, guys? Type in your answer. Name me some companies that fit the category. Okay, people say Alibaba, correct. Alibaba, Apple, Microsoft, Alphabet, correct. Amazon, correct. Johnson & Johnson, no, not Johnson & Johnson, because Johnson & Johnson is not a growth stock, right? It's not a growth stock. Adobe, correct. 3M, no. Disney, no. Okay. Netflix, yes. Netflix, I would agree. Netflix, yeah. Facebook, yes. General Motors, you got to be kidding. Abine, right? PayPal, well, maybe, right? But yeah. Zohai, correct. VEEV, correct. VEEV, right? NVIDIA, yeah. Okay, correct. All right, great. So basically, let me give you some examples. These would be the MAGAF stocks. MAGAF. What does MAGAF stand for? Oops, sorry, a bit fast over here. These are the MAGAF stocks. So MAGAF would be Microsoft, Apple, Alphabet, Amazon, and Facebook. Okay. In China, you have got Tencent, which dominates social media. It's their version of Facebook and Instagram and WhatsApp, right? You have got Alibaba, obviously. Okay. And you've got like Meituan, and you got some other companies like VEEV. In fact, this company was a company that I started buying about a year ago, and an alert was sent to all my students. All right, you can see over here. Those of you who are in my Ultimate Investors Playbook, this is a subscription where you get to watch my live account. Every time I buy something, I sell something, you are notified of it immediately. All right. So this was back on March the 2nd. You can see that I shared with my students. I just added VEEV at $140 at the support level, right? So this was March the 2nd at 140. Let's see where it is right now. Right. So I entered, let's see, March. Yeah, over here. March the 2nd, right? And after I entered, sure, it went down initially because of the COVID crash. No one could predict it. But since then, it's now at 274. All right, so it's about 100%, yeah, about 100% gain in less than 1 year from this position I entered. All right, so that was a great investment actually. So yeah, VEEV is an example of a large cap growth company, right? Okay, the second category are large cap defensive stocks. So notice I use the shield as a representation, right? Defensive stock. So now these are companies where they sell a product or service that never goes obsolete, like alcohol, right? You think about alcohol today, beer, wine is the same as 100 years ago. It never goes obsolete. Toothpaste today and 100 years ago is still the same toothpaste, right? Soft drinks today and 100 years ago, they're still the same soft drinks, right? So these are companies where they sell a product that tends to be defensive. Now, defensive means that they are essential items, which means regardless of the economy, you have to still buy toothpaste, you still buy batteries, you still buy sanitary pads, you still buy potato chips. Okay, so these are essential items that are defensive, and they've got very low uncertainty in earnings and cash flow. So regardless of good and bad times, their sales and profits rise consistently. They have got wide economic moats with little or no competition, slow but steady capital appreciation. But these companies, unlike the growth companies, they don't grow at 20 to 30%, right? So toothpaste companies don't grow at 20, 30%, right? You know, PepsiCo that sells snacks, potato chips, they don't grow at 20, 30%. They grow at 5 to 10%. So the first one I showed you is kind of like, you know, the really fast grower, the rocket. This is kind of like the slow and steady turtle in the race, okay? But why do we want to buy these companies? Because they are the most resilient during a bear market and economic recession. So whenever the market collapses, whenever there's a bear market or recession, what happens? These companies, they don't go down, or they go down a bit. In fact, they may even go up, right? So for example, McDonald's is an example of a defensive company. Predictable. Burgers are burgers, right? In fact, during the financial crisis, during the dot-com crash, when stocks dropped 50%, McDonald's went up. Because guess what? Right? In a worse recession, people still go to McDonald's, right? People still drink Coca-Cola. People still eat snacks from Pepsi. Cool, right? So what are some examples of defensive companies, guys? Give me some examples of defensive companies. That's right. Johnson & Johnson, Coca-Cola, Procter & Gamble, Unilever, that's right. Costco, correct. Yum Brands, correct. Yum China, correct. Clorox, yes, correct. Starbucks, not exactly. Hershey's, yes, Hershey's, right? 3M, no. 3M is a cyclical company. 3M is cyclical. Kimberly-Clark, yes. Walmart, yes. Agreed. Kraft Heinz, yes. But Kraft Heinz is no longer a great business, right? So, don't ever buy Kraft Heinz, in my opinion, right? Okay, so again, you can see that on February the 28th, I sent an alert to the community. I'm adding J&J at 131. Johnson & Johnson, let's take a look at Johnson & Johnson. Right, so you can see that it was in a big consolidation. Can you see that? You see this consolidation, ding dong, ding dong, ding dong, ding dong, right? So in February, over here, this was February, right? I bought it at 131. So why did I buy it at 131? Because it's undervalued, and you can see that it hit a strong support level over there. So you buy at the support level. So buy over there, all right? And of course, you can sell it over there. You can buy it back, sell it over there, buy it back. I just kept holding on to it, right? Because I use options to sell covered calls at these levels. And the intrinsic value, you can see in green, is 147 to 155. So that's the intrinsic value. So currently, Johnson & Johnson is at fair value. It's not expensive. It's not cheap. It's at its intrinsic value. So it's no longer attractive here. But when I bought it here at 131, it was attractive because it was undervalued and at a support level, right? So sure enough, at 131, I bought it. Now it's 146. Yep, I made not a huge return, but not a bad return as well, right? Making money is always good, okay? Okay, next category are large cap cyclical stocks. Okay, let me explain the difference. When you buy a growth stock, like Amazon and Facebook, right? This is what you see, okay? When you buy a predictable company like PepsiCo or Procter & Gamble or Colgate, right? It's something like that. Okay, so this is like a lot steeper. This is less steep, okay? Now, for these companies, cyclical stocks, what does it look like? What do you think it looks like? Remember, every stock category has its own pattern. Okay, so these companies look like that. Whoa, 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 whoa. That's right. These are cyclical stocks. So they go through big ups and downs. Does this make sense? Okay. So for cyclical stocks, you only buy them when they are near the bottom of the cycle. You buy them here and you got to sell them at the top of the cycle. Right? These are cyclical stocks. Okay. So these are large companies that sell products or services that are highly dependent on the economy, like 3M, like Caterpillar, like Honeywell, for example, like banks, JP Morgan, Bank of America, right? So these companies, they generate a lot of sales and profits during economic expansions, but they also make a lot of losses or lower profits during recessions. So they make a lot of money, lose money, make a lot of money, lose money. very cyclical, like a roller coaster. So example, real estate, developers, banks, commodity companies or material companies, energy companies, industrial companies. So the stock price is highly volatile with long-term peaks and troughs. And like I said, I only buy cyclical companies when they are at the bottom of the cycle. So let me give you an example of one of them which I bought, which are the banks. So in the US, I bought JP Morgan, Bank of America. In Singapore, I bought the Singapore banks like OCBC. You can see this is my alert again, just added to OCBC on the Singapore Exchange with a 5% dividend yield, right? And my position in the 3 Singapore banks is a $600,000. I bought 600K worth and I'm building up to 1 million by the end of the year. All right, now it's worth about 700 grand. Okay, now why? Let me tell you why I bought these 3 banks. Let me show it to you, the chart of the banks. There, okay. So this is the OCBC Bank, which is one of the banks in Singapore. And you can see, whoa, baby, oh, Nelly, yes, yes, yes. So you can see here's a strong support, right? So I bought there, right? And now I'm waiting for it to go, hallelujah, back up there. So it's a cycle. It's a cycle, right? Another one is DBS, which is the biggest bank in Singapore. Again, look at the cycles. You can see the big cycles. Can you see the big cycles there? So I started buying here at about $19, $18, $19. Now it's going back. And once it reaches about 32, I'm getting out, right? So you catch the wave, you catch the cycle. So every company is different. You have to understand the type of company you're looking at. Okay. So we talked about large cap growth companies, large cap predictables. We talked about cyclicals. The fourth one, can you see this unicorn? Right. These are speculative growth stocks. So in this category, we look at new growth companies that have the potential to become white moat companies that will dominate their industry. But they currently only have a narrow moat. So in other words, right now, they are not a monopoly yet. They still have a lot of competitors, but they have the potential to become a monopoly in the future. But right now, they are not making money yet. They have a lot of debt. So they are still risky. It's kind of like, it's still a baby that's not strong yet. Okay, but there's a lot of hype. And usually their sales revenue is growing at 100%, okay? But they are yet to make consistent profits. They are not making consistent profits, and their cash flow may still be negative. Company could still be making losses because of high investment costs and lack of economies of scale, all right? So for these companies, the profit is negative. You can't use a PE ratio to value the company. Their cash flow is negative. You can't use a discounted cash flow to value the company. So the only way to value this company is by using what is known as price to sales growth ratio. The price to sales growth ratio, which is you take the price to sales ratio. You take the price to sales ratio. And you divide it by the revenue growth rate. And if it is 0.2 or less, then it is cheap. But if it is way above 0.2, if it's like 0.5 or 0.8, then it's bloody expensive. It's bloody expensive. Does that make sense? Okay. So I'll give you an example in a while of how we calculate that. Again. So this is a higher risk investment as the company will not pass some of the steps yet. Again, may still be losing money, it's got a lot of debt. So would I buy these companies? Would I buy these companies? Well, I would tend to trade them, more like a one-night stand and not really an investment. So the difference is when I go in as a short-term trade, I tend to use options instead of buying the stock. I just buy the options, or if I buy a stock, I'll put a stop loss, and the moment it falls by say 8 or 10%, I'll cut my losses because they are very risky. So you just have to ensure that in your portfolio, you don't have too many of these stocks, because yeah, they can make you a lot of money, but they can kill you if they don't work out. So I call this kind of like, in a meal, this is kind of like your hot sauce, your chili. Okay, so it's good to have some chili, some hot sauce to spice up the meal, but if you put too much chili, too much hot sauce, you could get indigestion and you could throw up. Does it make sense? Okay. So I usually take a smaller position. Okay. Now, the fifth category are what I call turnaround stocks. Now, turnaround stocks are great businesses, but have been temporarily hit by some kind of bad news, like a lawsuit or boycott. Like, example, a year ago, Facebook was boycott. People were boycotting Facebook, and they were under investigation by Congress. So because of the bad news, Facebook fell by 30 to 40%. And that's when I bought a lot of Facebook shares, right? I bought a lot of Facebook shares. You can see my Facebook shares. Yep, over here, I bought it at about $182. That was when it dropped during the boycott and the panic. I bought it at 182, and now making pretty good profits on Facebook as well. Okay. Another example would be Boeing, right? Boeing was hit by the pandemic and the plane crash. So the share price dropped by 50, 60%. So I was buying it when it was going through all that bad news. And now I'm making money on Boeing as well. Another one is Booking.com. Booking.com is the largest tour agent in the world, right? It's an online tour agent. And because of the lockdown, people can't travel, the profits were hit and the stock fell. And you can see that on the 27th of April, I sent a message to my students. I said, I just bought an initial position into Booking, right? Because I'm betting on the rebound of the travel industry. So I bought it on the 27th of April. At what price did I buy it at? I forgot. 27th of April. 27th of April. Yeah, I bought it somewhere there at about $1,800. So I bought it at 1,008. And of course, oh, sorry, wrong. Not April last year, April this year. My bad, right? Let me zoom to 1 year. Yeah, okay. So I bought it here. That's right. I bought it at $1,400. That's right. Okay. And right now it's at 1,009. So I've made about, let's see. Yep, I've made about 42% return on the stock. And I recently sold half of my position. So why did I sell it? Because you can see that right now, there's a strong resistance over there. Can you see this resistance over there? Right? So boom, down, boom, down, boom, down, boom. And right now, it is overvalued. You can see it's above the intrinsic value. It's hitting the resistance, so it's a good time to sell, to take profits. If it goes back down again, I'm going to buy more. All right? So you can see this was my initial buy on the 27th of April. And this was just 2 days ago. That's right. I said, I'm selling at this price. I'm going to exit my position to redeploy to another great company right there. This was just sent out. My alert was sent out just about a day or 2 days ago, right? Okay, the final category would would be companies that are known as income stocks. And I call them dividend cash cows. The objective of buying these companies are purely for collecting dividends. So these companies don't expect them to grow very much, right? They could be going sideways or going up slowly, but they pay good dividends of at least 5% a year. All right. So I normally buy these stocks when the dividend yield is at least 4 to 5% a year. They consistently increase their dividends per share for the last 5 years. And of course, they're increasing their net profit and cash flow. And they have got low debt, all right? Now, the important thing is when you're buying companies for dividends, only buy defensive and predictable companies. Avoid cyclical companies. Avoid property developers. Avoid banks. Avoid airlines. Avoid shipping companies because these are cyclical. When the economy goes bad, they can't continue to pay a good dividend. Does that make sense? So you want to buy companies where they are defensive so they can pay a higher dividend every single year, right? So does it make sense? These are the 6 investment categories. So I hope that's useful to you, that when you build your portfolio, like I said, you want to have a good balance of these companies, okay? Now, personally, for me, I would say roughly about 50% currently, about 50% of my portfolio are in large growth companies, about 50%, and about, I would say, 30% are in defensive companies. I would say, yeah, about 20%. Yeah. Cyclical companies, about 20% as well. Okay. And for turnarounds and speculative growth, these are like the hot chili sauce, where they're more risky. So I only allocate 10% of my portfolio to this. And for dividends, to me, it's a totally separate portfolio altogether. All right. So roughly this is my allocation, but there's no right or wrong. It depends on you. If you're more aggressive, you would have more allocation to large growth and to speculative growth. If you're more conservative, then you want more defensives, more dividends, and less speculative growth. So, like I said, we are all different. We are at different stages of our life, different objectives, different risk tolerance. So you have to build a portfolio that fits your objectives. So in the value momentum investing course, I teach you how to build a winning portfolio that fits your objectives. All right. Does that make sense? So like some people, they need to eat more meat. Some people, they avoid meat. They eat more carbo. Some people avoid carbo. They just eat vegetables. We're all different, right? But you have to understand how to build a winning portfolio. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.